Dhirendra Tiwari is also joining us on the show from Antique. Dhirendra, good afternoon. Long time talking to you. Let's talk about the recent note you put out on budget-related, commentary. You expect this budget to be stimulating growth. Talk to us about the rationale and what signs you are reading right now on the economy.
Hi, this is to me. I mean, I missed, I think there was some connection problem.
Just going through your report ahead of the budget, and you are making a case for a rural kind of a budget stimulating growth in the economy. Talk to us about your rationale, Dhirendra.
Yeah, we think that this is an important budget this time around. It will have an impact on the market as well. So one thing is very clear that there is growing impetus on boosting the farm income. There is a growing impetus on boosting the rural economy. So that is the reason we believe that there is a likelihood of increased outlay and expenditure on some of the schemes which cater to rural markets. So that's where the point actually is reinforced in our report as such in this strategy.
Dhirendra, what are the kind of stocks and sectors which will be in focus in your view, not only by budget triggered spending, but also overall the economy bottoming out and chugging along? Because you look at deep cyclicals like capital goods very well, you have a good handle on the capex related plays. So what are the sectors and stocks on your radar because of that?
Yes, as we have written, a lot of thrust will be on rural market, agricultural market, and also infrastructure. So one can always see some thrust on these sectors, and therefore what I feel is that the sectors to be on focus for investors should be consumer sector, which is FMCG, agri sector, which is seeds, fertilizers, and agrochemicals. We have infrastructure sector, which is basically construction, EPC, and industrial. We also believe that there is a bit of improvement in the growth outlook for the banking sector as well, and the credit growth is picking up, and therefore selectively PSU banks and the private banks. So these are the sectors where we think the growth will strengthen going forward in FY19 and 20, and therefore it is important for investors to look at stocks very selectively where the growth is at a reasonable price. So that's where our overall thought process lies.
Hi there, Dhirendra. Avan joining in. Now, you've spoken about some select sectors. Would like to understand your earnings outlook as well. What have you made of the earnings that have come in so far? And do you think that we are likely to see some sort of an earnings stabilize, continue going into the coming quarters, largely on the back of the fact that, the big worries, so to speak, which was GST and demonetization, seem to be out of the way?
Earnings have been pretty decent so far, and one can argue that the sectors across board have done reasonably okay, barring few exceptions. So we believe that the earnings trajectory will only improve. The only catch could be the public sector banks, where earnings predictability is very difficult. But if you look at consumer sectors, FMCG, a little bit of paints, chemicals, if you look at even the private banks and some of the IT companies, the earnings by far has been pretty okay. It has been decent. So we think that overall for the year as a whole, we finally will end up maybe close to 8-9% Nifty earnings. Once we see the companies which to be, sort of laggards as far as EPS is concerned, turning out better numbers in FY19, then the growth can be 15 to 20% in FY19. So that is where we see today. So if you look at financials, one segment which is private sector bank is doing well, but public sector is not doing well. So those are the deltas that will be seen probably in FY19. Therefore, on a basket basis, you will see much better growth going forward in FY19.
Dhirendra, you've spoken about a lot of sectors, but from the budget point of view, I'd like to get your attention back. Housing, infra and agri are the areas you think the budget will focus on. But what do you think would market want to know on the fiscal consolidation or fiscal deficit target front? What kind of messaging do you think the government can make in order to not spoil the market sentiment, but still deviate in a mild manner as far as their target is concerned? And if that doesn't really happen, what kind of downside we are talking about in the market?
See, fiscally it has been much better managed, I would say. Just maybe 0.2% slippage will not be a big deal, because if you see, this has been the year with massive reforms like demonetization and also GST. Globally, we have seen such reforms have created slowdown in economies, and fiscal situation going little haywire. So India has been able to sort of take these reforms without much of an impact. So if we look at GDP growth, it has been well over 6% still, despite these mega reforms, and also minor slippage in the fiscal deficit. And therefore, I would assume that the country has managed it very well politically as well as economically, and that is very positive for the market as a whole. So my sense is that if one sees minor slippage this year, and with the promise that next year will not be any major slippage, the correction in the market on that account will be limited. So whatever one can argue, there could be other reasons for the correction, but not a minor slippage in the fiscal deficit as such. So I would assume that market will also be looking at what is the growth next year and what is the fiscal situation next year, rather than the number which is already known to most people, and therefore FY19 will be very crucial.
Dhirendra, also your team members and of course you keep traveling across the world to meet big investors. How are they positioned right now as far as Indian equities go? Are they fully invested, or are they looking at certain sectors to go overweight? Also in a year which is having 8-9 state elections and of course going into the main election, what's the positioning of your client community, mainly from the foreign side?
Clients have, if one go by the foreign investors, FIIs, I mean, there has been a bit of concern primarily because of steep rally, 25+% return in Nifty during the year, and the market trading upwards of 18 times P. It's basically a little bit of discomforting for a few investors, and that is the stance that we have seen, and therefore the action has been slightly on the negative side and on the neutral side, and as you rightly pointed out, FY19 is a very sort of politically very active year, and this is a lot of elections and finally going into a major election. But having said that, there would be also a feeling of being missed a rally which is pretty profound